Good afternoon and welcome to our continued analysis of South Africa's national budget. My name is Fifi Peters. If the markets are anything to go by, the budget that was just delivered by Finance Minister Tito Mboweni was not as bad as expected. We have seen the rand strengthening and the JSE coming off its worst levels following that budget speech. We will continue to get insights from the experts that have kindly given us their time today. Of course, that is Muneer Hassan, a senior lecturer of taxation at the University of Johannesburg, Stephen Meintjes, the head of research at Securities, and also Nolwandle Mthombeni, an investment analyst at Mergence. So we've just shown you a quick peek of what the market is doing, a quick peek of what the rand is doing. Let's perhaps get those numbers up once more for you before we kick off this discussion. Well, let us kick off the discussion, and Nolwandle, if you allow me to start with you, and let's pick up from what that market is doing, because if we continue at this pace, we could possibly end the day positively. And this is a stark contrast to what we did see earlier on in the day when the JSE was down over 1%. What is it that investors are interpreting in this budget as being not as bad as was expected?
So this was a purely pro-consumer budget. As long as there's tax relief and the bracket inflation creep was more than 6%, it's driving growth for consumer. So what we're seeing now in terms of the stocks, any consumer-facing counter, your consumer, your retailers, your banks, they're going to be the beneficiaries there, because now what the market is saying, the consumer can go out and spend more, and that's what we're saying. It's being translated into the JSE because we're seeing the consumer is going to get some relief, much sought after relief, which is what they're probably relying on to get that better tax revenues that they're probably budgeting for.
For sure. I mean, they're just looking at some of those stock movements. Truworths up 8%, Shoprite's up 7%. So these are consumer-facing stocks.
Exactly.
Relief has come to the consumer, possibly finally. But Hussein, just to come to you right here in terms of your interpretation of the budget, what was your feeling about what the minister did say?
Fifi, anything that's when we avert the tax rate increase, that's good news for the consumer. So obviously on the individual side, we're seeing no immediate increase. We actually see, like Nolwandle said, there's some bracket relief that's come through, which is good. In the past, we were used to more. But remember, last year, we come off a base where we had no bracket relief at all. So in the context, it's good news for the consumer. Also, from the company side, it stays at 28%, but they are widening. There's some sneaky changes coming for the company.
Yeah, what did he mean by that in terms of ordering the
there are two big
base?
issues that's coming over there. The one issue is what they're looking at is to cap or limit the interest deduction that a company can get to 30% of the income earned. Now, that goes against everything I've thought as a lecturer, because normally your expenditure that you earn in the production of income is deductible. But what they are doing is they're saying, hang on, even though it's actually incurred and it is through expenditure, we're going to limit it to 30% of your income. The reason they do it, and I fully get why they're going there, if you think about the base erosion of international companies over here, what they simply do is they create a huge expenditure item on interest and move the income offshore to a low tax jurisdiction. For example, Mauritius around the corner is at 15%, we're 28% on the company. So I totally get where they're going, but in the longer term, what that may have an impact on is the consumer ability to actually to spend again, because we all know what companies will do if we come hard on a company, and that is that they're going to cut staff costs. That's where they'll go to. And that comes in a vicious cycle back to actually the consumer spending pattern of the individual and VAT, in fact. So that can in a couple of years come back and bite us.
Yeah, for sure. I mean, I do also see, in terms of that tax, there were also some adjustments made to foreign remuneration within that regard, but we'll unpack that further in just a moment. Stephen, for you, we've heard this is a consumer-friendly budget. This is possibly a corporate tax-friendly budget. What is your interpretation of what the finance minister had to say by way of South Africa's numbers?
Well, I think that the corollary of letting the consumers off the hook, and I think the market reaction is a relief reaction, because a lot of people were expecting the consumer would get hammered even further, is the addressing the public sector wage bill, and that's pretty well hanging in the air. That's got to be addressed soon, and he sounded quite optimistic. In fact, his whole delivery was super genial and super jaunty. But it remains to be seen whether how much they achieve on that. And there was a certain kind of symbolism in the public office bearers not getting any increase. You know, the taxpayers, the public being let off, as it were, and those who one could say might have been responsible for where we're at, having a little bit of a check on their remuneration.
So explain how that works, though, because in as much as public sector hiring has increased significantly, there has also been a slowdown, which he did mention since around 2011, 2012. And he did say that, you know, once we got rid of corruption and wasteful expenditure and things like that, we could see a pickup in hiring. So it seems like two forces there at play for me.
Yes, the people who are not getting any increase are the office bearers, so
Right.
that's elected representatives, a relatively small number of people, but nevertheless there's some symbolism there. No, he's obviously hoping to make the whole public service a lot more efficient, letting people go where they're not required, and as he said about the nurses and teachers and so on, people who really are in the front line, that they need to be helped and encouraged and so on.
And so on. I just want to speak about another stock, Nolwandle. We were discussing this in the newsroom about the potential impact that the new taxations that will be introduced on tobacco-heated products, e-cigarettes and vaping and the like, would have on a counter like British American Tobacco. I mean, the traditional excise duties were increased in line with inflation as is expected, but this introduction of this new tax on a player like BAT, is this really meaningful or not so much?
So BAT has been facing regulation everywhere. So they're one of the biggest tobacco companies in the world, and they've been at the forefront of getting scrutiny and increased regulation. So what they've, the way they view it is that the more regulation, the better it is for them, because the smaller players fall off they just fall off because they cannot keep up or maintain, or don't even, financially, they don't even have the muscle to stomach the regulational issues. So someone like, BAT, I mean, vaping is still very small, especially in South Africa. It's a very, very small market. And, they're also introducing products. And because it's so small in terms of what they're contributing, it's not going to be meaningful. But it does make it harder for very much smaller players, and ultimately it's very anti-competitive. So, the government, obviously it's a way for them to generate revenue, but they are kind of killing off competition in that space.
I mean, in terms of that revenue generation, against the fact that, we're spending a whole lot more than we earn, how far do you think that this budget does go by way of trying to achieve that? And especially in now an environment where we're talking about a relaxation on personal income taxes and corporate taxes possibly.
I think what's happened is that Treasury has recognized the fact that we've got pressure on revenue collections at the moment. So we know that they're saying that there's going to be an under collection already at the end of the year. So they're forecasting a budget deficit in terms of revenue collection on the top end. So what they've done, and I think every analyst has done this in the past, is always said that South Africa doesn't have a revenue problem. We actually have an expenditure problem. And what they've done this year is for the first time to look at actually curbing expenditure. They looked at actually trying to see where they can reshift money, reshift focus as well. But like you said earlier, what they've done is that they're heavily reliant on actually saving the wage bill. And it's almost as if this budget hinges on the success or failure of actually negotiations with trade unions and actually making sure that we actually save. The number is 37 billion that's actually mentioned in the budget on saving in public sector employees. Yeah.
Talking about the trade unions, judging from what the minister did say, it seems like they were on board with some of the difficult and painful, in fact, he said politically painful decisions that would have to be made regarding the public sector wage bill. I mean, how convinced are you that is the case?
Well, apparently Kasatu was venting against it last night on television, but we hope he's right in that they are engaging responsibly. I mean, everybody knows that they've had above inflation increases for a number of years and so on. There was one interesting aspect talking about expenditure, but making sure that what has to be spent is spent and driving it through to the municipalities and seeing, instead of taking the money back to National Treasury, ensuring that they do actually spend on infrastructure if they're supposed to be, and that they maintain what they've spent on. So I thought that was interesting, and that's an example of a lot of what he was talking about, the capable state, the secret lying in the execution thereof. So a lot depends on there being a lot more efficient execution.
This is the Minister's second official budget, as we were discussing prior to the show starting. How different is it for you guys from what he has said previously? I mean, is this the kind of budget that really gets this economy growing, or not so much?
Well, the first, it didn't have the baobab tree. So, I mean, I was looking forward to seeing that. So I think, I think what is very key in this one is that he's said we're making the tough decisions. Before he was kicking the can down the road, but this time it's the cuts. The cuts that didn't want to say, he had to fight people through. And now, I think, and we've seen in the last couple of weeks where COSATU and the unions are just starting to realize that there needs to be some sort of social compact. So now it's really about that tough decision that the rates and these agencies have been waiting for us to make. And that is, for me, what is very key and very different to this one, is that instead of kicking the can down the road, I mean, I think in the medium-term budget speech, there was a lot of kitchen thinking in terms of the expectation around where the debt to GDP would go and where the everything in terms of those metrics. So I think now it's just about now, okay, we've set expectations around where this debt level will go and put it out there, but now we're going to make the difficult decisions where we were not answered in the MTPS.
Muneer?
Yeah, I think I read into it that there's definitely a lot of thought that has gone into it. So tax to GDP ratio is something we look at in terms of the maximum that you can take and extract out of a taxpayer. And we hit 26% last year already. And the international average, the moment you start going beyond the 26% mark, is an indication that you're over-extracting from the taxpayer. And I think what he's done very smartly is that I cannot go to revenue increases. I'm off tax increases for now. I'm going to have to go to expenditure and start curbing expenditure, and that's not populous. That's not going to make him popular, but I think he's taken some tough decisions over here and said, look, we're going to go down the road of trying to curb expenditure, which we've all been talking about for so long. But having said that, I must say that when I say it's very smartly articulated and thought very carefully about, is that when you go into the detail, that when you start unpacking things like what's happening in the company, the interest limitation that we spoke about, there's another issue that they're going to look at for companies, and that is that they're going to limit the assessed losses as well that a company can get in terms of setting it off against your taxable income. So that's a huge change. So what we're seeing is, even though he's saying on the surface we're going to keep tax rates at 28%, however, we're going to widen the tax net of the company itself. For example, he's talking about looking at limiting the capital allowances that companies get. So all that simply means that we're going to actually widen the tax base for a company. And I actually think in a couple of years' time to come, once the companies actually start paying more taxes, he's going to actually drop the tax rate, because we're actually anti-competitive on our tax rate at the moment. If we look at our competing international countries, it's actually, the trend is to actually move down on company tax rates.
And he has been quite vocal about that. Companies are not being taxed too much, improving the ease of doing business. But Stephen, just going back to the original question around the two budgets that the minister has delivered thus far, and for you, what are the stark similarities, the stark contrasts this time around?
Well, I mean, very much the body language, as I said, was super genial, super jaunty. Previously he was perspiring, and it was like hard work. This time he was confident, and he was ready for whatever's coming. And I think he, include those negotiations with the civil service.
But just talking about the very difficult decisions by way of the cuts that he had to make, and if you can just assist me here in my interpretation, because I see that there's major downward adjustments in quite a number of areas. We're talking human settlements, the health system, we're suspending the integrated public transport networks in certain municipalities, and even on education. So is this correct, and how does this translate into a better economy for the people on the ground?
So I imagine that they had to really scrutinize every single rand of expenditure. So we might see that maybe there's allocation to education, but there might be something there, that one miscellaneous item which really they can't do without. So I think in terms of the budget, for example, education, the biggest budget is salaries. That's the one big thing there. And then the number that they put in there that relates to education, for example, the expenditure cuts, or probably maybe spending on infrastructure. But those, I think you can, shift it out for 2 years and then get back on it. So I think they're really taking a very short-term view in terms of the infrastructure spend, hoping to curb down the wage bill, and then they're going to play catch-up. So that's ultimately what we're going to do. So in terms of all those line items there, they're really saying, okay, we can do about this for 18 months. Let's just get things stabilized, and then we need to make sure that the revenue is boosted and the tax revenues come through. So now we can go back to spending on the important essential infrastructure spending that is required to grow the economy even further.
I mean, tough decisions, but I don't know. I kind of get the feeling that he made some form of, or gave some form of exemption, reluctantly so, however, to the likes of SAA. I mean, Eskom, SAA, once again, getting a bailout. It's where is the degree of toughness here?
Yeah, I think when I looked at the numbers, he's saved 66 billion, and the bulk of that, more than half of that is actually hinging on the wage negotiations.
Right.
And what he's done is he's located, like Nolwandle said, some program expenditure to different sections itself. And 44 billion of that then gets redirected to our state-owned entities that are struggling, like the likes of Eskom, SAA. So there is a bit of this reshuffling and sort of reallocating monies from one pocket to another as well, because those state-owned entities, it's imperative that they actually work to keep the lights on.
Sure. Stephen?
Yes, well, I don't know that you can say he's kicking the can down the road on SAA, but I mean, it's still open-ended, to put it politely. So that remains to be seen what happens there.
So as we round up this conversation, I'm just, so now that we have a plan of how money will be spent in this economy over the medium term, and we've got an understanding of perhaps how much growth the capital expenditure can contribute to, how does that change as from a market's perspective? How does that change the way that you're looking at the market, particularly the SA Inc. stocks that are up phenomenally today?
So my one big concern is that obviously what we talked about in terms of the excess losses being maybe limited or done away with, and the net interest expenditure it's quite significant for companies that are very indebted. If you look at the JSE, there's many companies who have got these high interest bills, high interest net costs, because they got too much debt on their balance sheet, and they were relying on those assessed losses and those net interest income expenditures and deductions to kind of get them through this rough economic cycle. Unfortunately, while he's got this budget coming through, it doesn't necessarily mean that the GDP growth is going to suddenly shoot out the lights that could offset what's happening in terms of the debt and the not being able to set off your interest income. So what's happened is that the income got the consumers got the relief, but the companies got have to, especially the ones that got a lot of debts on their balance sheets, they're probably going to feel the pain. So I think from a market's perspective, the consumer stocks probably going to be in favor, and in terms of any overgeared companies that are listed there, it's going to be tougher for a little bit longer.
Tougher for a little bit longer for highly indebted companies. Stephen, your portfolio management, does it change, or your investment outlook of where JSE, the Aussie, is going, and SA Inc. stocks, has it changed by any way of the budget?
Well, I think as we say, the consumer side, there's a momentary relief there. So it remains to be seen when and whether the economy does get going, whether the much touted reforms are happening. Our economists have got a whole long list of all the reforms that have been undertaken, and there are a lot more boxes, like 40 boxes ticked and about half a dozen crosses. In other words, that's all incremental. It doesn't hit the headlines, but is it going to work? But then, of course, we've got the global situation we're facing. We haven't talked about the wretched virus. And then we've got a precious metals.
Did he talk about it much? He didn't talk about it much. I know there was an allocation of some money to disaster management, but that was, around drought and weather-related issues. What are you expecting there?
Not enough time probably to incorporate it.
One of the biggest risks on the market, perhaps, to be fair. But yeah, so what are your concerns around that coronavirus?
Well, I mean, America is going over to full-on action stations, and America's worried. We should be thinking, what happens if it comes here? I think I've heard some statements from the health minister that, we're okay, but if the Americans are really worried, then I think we should be.
And perhaps maybe more so now that we have had expenditure cut back in the health sector. I mean, just to wrap up, we didn't mention the carbon tax. I see quite a lot of money is expected very soon from the implementation of that tax, some 1.75 billion rand. So perhaps you can comment, Muneer, on the carbon tax And yeah, the outlook on other tax measures there. See also another increase in the plastics levy.
Yeah, so I think what he's done is he's managed to look at getting about 2 billion between the carbon tax and plastic bag levy.
Yeah.
And what he's doing is that is exactly where they're going to get the funding to provide bracket relief, as we call it, to the individual, so that shielding the individual against inflation, which would sort of give back into the tax stables itself. So I think welcome, but talking to the earlier point, I think they are definitely reading into the fact that in the foreseeable future, things will turn, growth will come our way, and when that happens, then he's hoping that the company is going to come to the fore in terms of getting more collections out of the company.
Right, and just lastly, very briefly, the impact of the tourism levy specifically. Potentially, what do you foresee there?
Yes, I think in terms of tourism levy, obviously in terms of actually getting tourists excited into the country itself, we're obviously looking at more tourists coming into the country, but in terms of taxing them and getting the levy going over there, it can be negative as well. Okay, it can be a twin negative against us.
All right, but I suppose as Stephen would say, let's hope they are not tourists that bring the wretched disease in the country. But thanks so much for your time. We're going to leave it there for now. Of course, I was joined by Muneer Hassan, who's a senior lecturer of taxation at the University of Johannesburg, Stephen Meintjes, the head of research at Securities, and Nolwandle Mthombeni, an investment analyst at Mergence.